Let's talk about a company here. You want to dissect a company?
Let's do it.
All right, let me Axion.
Axon.
Axon. That's the way it looks, but I want to add something too. But Axon is the company. Actually, Axon Enterprise is the full company name. Symbol is AXON. They're in the aerospace and defense industry. Float on the short side, only 3.2%. 84% institutional owned. PE ratio, well, not a good start here. 174 versus 53 for the industry. Price to sales, wow, also expensive. 17.8 versus 2.8. Price to book value, 14.4 versus 7. And price to cash flow is 187 versus 31. Wow, these valuations are just ridiculous. I don't know how to say it. And then when you look at the earnings over the last year, they're down 17.9% when the industry was up 4.9. Sales, this could be why people are paying up for it. Could be a dangerous thing, but sales were up 31.8% for the last year versus a decline of 4% for the industry. Analysts hyping this up, a 5-year earnings per share growth estimate, 52.3%, while the industry is a negative 27. They do not pay a dividend, so nothing there. Let's see the balance sheet. Current ratio looking very good, 3.1 versus 1.5. Debt to equity is in check at 0.7 versus 0.8. We do see a net profit margin of 10.1 versus 5.7. That's a positive. Return on equity, not so good, 8.5% versus 18.3% for the industry. And the free cash flow is only $145 million versus $2.4 billion for the industry average. So this is kind of scary, and I don't know why we picked this company. I think I know it's a great company, and we're going to more to talk about it, but gosh, these numbers look frightening to me.
Well, I mean, it's pulled back quite a bit, but I think it just got so crazy expensive. I mean, it looks like last week the stock plunged about 19%, and it was pre-market trading. I'm not sure how it ended that day, but it was because of an earnings miss. They had sales that they came in nice, up 31% from a year earlier. So again, it's a great growing company, but adjusted earnings came in at $1.17, which was short of the consensus of $1.54. And that's what can happen with these hype stocks. You come in with a miss, I mean, you can just get taken down so quickly. I mean, you look at the current price here, $554.37. That 52-week high, $885.92. So we've seen a pretty substantial pullback, which was like, hey, maybe you could get a good company here on sale. But I think this thing just ran way too far ahead of itself. And especially you look at even still what you're paying for the future earnings. You go out to December 2026, estimated earnings per share, $7.56. I mean, that gives us here a target sell price of just $125.50. It trades at over 73 times those future earnings.
Yeah, and you don't know how long the hype lasts. And yeah, congratulations if you made money on it. But here again, we come back to what you're paying for a business. It's well overpriced, nothing great in the future. Doesn't mean the stock won't rebound somewhat. But again, the whole reason why you buy stocks or invest in stocks is for the earnings. And the main thing you don't want to do is you don't want to overstate or overpay for those earnings. That's the other big thing.
Yeah, I mean, this is almost like NVIDIA type returns. 10-year return here is almost 3,000%.
Oh, wow.
You go back to the max chart here. You go to 2001, it looks like, is when this company was public. It's almost 100,000%. I mean, you've done so good in this company, but gosh, those valuations are crazy. And as I said, I mean, I have a friend that's a cop, and he loves the products that they produce.
Great product.
And I have a friend that is in sales for them, and he always tells me about it. It's like, that's crazy. They have like body cams, and they have like AI, right? So that's probably why they're getting the premium here, the AI transcription services to help kind of officers reduce the amount of time that they're having to write reports. So, I mean, it's a great business, but gosh, is that just an expensive stock right now?
Yeah, the hype comes in, overprices the stock. Average investor goes in like, wow, this has done great. I better invest into it. They buy high, and then 3 years, 4 years down the road, oh gosh, I lost money. Stocks are so risky.
Yeah.
Stocks aren't risky. You do risky things.